A very good morning. Welcome to the 2021 Global Finance Conclave hosted by the Jindal School of Banking and Finance at OP Jindal Global University. My name is Ashish Bharadwaj. I'm Dean of the Banking and Finance School, and I'll be chairing this inaugural session. I'd like to thank the speakers for joining. Dr. Shankar Acharya, eminent economist and former Chief Economic Advisor, Dr. Subramaniam, Distinguished Professor and the current Chief Economic Advisor, Professor Kumar, founding Vice Chancellor of the University. I welcome everyone from our university, from all the partner institutions around the world who've joined this conclave. We are streaming live on YouTube right now. So thanks everyone for being here today. In the next 3 days, 60 speakers in about 24 sessions will reflect on the different strands of India's growth story from 1991 to 2001 and beyond, which is the theme of this year's Global Finance Conclave. The speakers in the inaugural session will share how they interpret the transformation of India in the last 30 years, given their vast experience in policymaking and what's coming next for India. In my opening remarks, I will, for a couple of minutes, take students in particular who are watching us back in time and our viewers down the memory lane, because what happened 30 years ago was nothing less than a dramatic, nail-biting blockbuster, really. So we picture India at the start of 1990s. In the background, a turbulent Gulf War, a global oil shock, a balance of payment crisis, massive fiscal imbalances in the country, excessive debt, savage license permit raj system, and backbreaking double-digit inflation. The external debt is so high that we owe almost a third of what we're making in our GDP. Moody's downgrade makes it almost impossible for India to take short-term loans. Our foreign exchange reserves can buy imports to feed the 850 million Indians for barely 15 days. India enters the year 1991 with a terribly choked economy that's on the verge of collapse. At this stage, Finance Ministry and RBI officials, and Dr. Acharya will correct me here, they approach the IMF for a loan. There's a story on this, possibly unverified, that in the middle of a very important meeting on the loan in Washington, D.C., news breaks that back home, Congress has withdrawn support to the incumbent government. This made an IMF official ask the visiting delegates, who are you really representing in this loan request? Amidst a deep economic turmoil and now political uncertainty, general elections are announced and they are held in early 1991 in India. Just a day after the first phase of voting began, in the world's largest democracy, the front runner to become India's next prime minister is assassinated. India loses Rajiv Gandhi and Indians lose hope for an economic miracle. By June 1991, India has a new prime minister, but there is no celebration. A new government, but there are no resources. Despite a vision and the ambition, the Indian economy continues to be on a ventilator. There's another unverified story on this, that the newly elected Prime Minister Narasimha Rao, immediately called for a meeting with the Cabinet Secretary and he asked him, is the economic situation really that bad? The response was, no, sir, it is certainly much worse. The same month, a mild-mannered economist and future Prime Minister of the country, Dr. Manmohan Singh, is promoted from Finance Secretary to Finance Minister. True to his style, he does what we don't see much these days. He holds a press conference to share a battle plan with the nation on how India will fight the grave crisis. By June 1991, I think it was mid-July 1991, in fact, 47 tons of gold is flown to the vaults of Bank of England so that the Indian economy can get a temporary lease of life worth about $500 million. The same month, economic reforms are unleashed, starting with a painful two-part devaluation of the Indian rupee. For the first time in our history, a completely new trade policy is unveiled. Head-turning public sector reforms are initiated and a radically new industrial policy reforms are finally announced, officially bringing an end to the infamous license Raj era. Shutters are now up and India is, it seems, open for business. There's a deluge of foreign goods and investments in the country coming in like drops of rain over parched land. The 1990s are now seeing ambassadors and Padminis zipping alongside Fords and Toyotas. Gold Spot and Citra are now refrigerated next to Coca-Cola. The name Nokia for the first time enters conversations involving MTNL and BSNL. Ye Akashvani Hai is streaming alongside Radio Mirchi. Cable TV allows kids finally change the channel from Doordarshan to New 8 Star and Z. Shopping lists are now featuring Sony and Samsung alongside BPL and Onidas. Maharaja is for the first time sharing the Indian skies with East West Airlines and Jet Airways. With this background, Dr. Singh presents a massively delayed union budget. I quote from his famous speech in the parliament on the landmark day of 24th July 1991, where he quotes Victor Hugo. No power on earth can stop an idea whose time has come. I suggest to this august house that the emergence of India as a major economic power in the world happens to be one such idea. Let the whole world hear it loud and clear. India is now awake. We shall prevail. We shall overcome. End quote. The reforms of the 90s continued. They changed the grammar of the country and the confidence of the people forever. After exactly 30 years and 3 months of that historic speech today, we reflect on the range of after effects that happened in the subsequent parts of this dramatic blockbuster called India's Growth Story. With these opening remarks, I'm very happy to invite our first speaker, Professor Raj Kumar, the founding Vice Chancellor of Jindal Global University and the of Jindal Global Law School. It's Raj's passion and vision that saw the dramatic evolution and rise of JGU, an entirely social sciences, arts and humanities-oriented university, to now be awarded the status of eminence by the government. JGU is now in the top tiers of Indian and global universities within a decade. I invite Professor Raj Kumar for his inaugural address.
Thank you very much, Ashish, and I would like to extend a warm welcome to all of you to the third Global Finance Conclave on behalf of the Jindal School of Banking and Finance and OP Jindal Global University. I would like to extend a warm welcome to our guest of honor, Dr. Krishnamurthy Subramanian, the Chief Economic Advisor to the Government of India, Dr. Shankar Acharya, former Chief Economic Advisor and the author of an Economist home and abroad, and also other distinguished speakers who are part of the session. My heartiest welcome to all our students, faculty members, and others who are going to be part of this fascinating finance conclave. We couldn't have had a more opportune time to do this. The various thematic sessions that are being formulated and are have attracted a phenomenally interesting group of people, augurs well for the kind of conversation that we wanted to have. I know that we have two distinguished speakers who will be interested to hear. What I thought, and Ashish gave a beautiful introduction, took us all back in memory lane when many of us are much younger to appreciate what was happening in the country. But what we can definitely take you is that it not only created a new vision for the future of India, but that vision not only impacted the economic sector and the society at large, but also it created new opportunities for institution building. I do believe that the idea of private higher education institutions created through philanthropic initiatives with a view to improve the quality of education and promoting excellence is an outcome of an idea, the time of which has come. OP Jindal Global University was created through a philanthropic initiative of our founding Chancellor and benefactor, Mr. Naveen Jindal, and from its early origins in the year 2009, it was entirely conceived to be a university that will make a substantial impact in the world of higher education. It has been lamented for many, many years by both Prime Ministers and Education Ministers of India that not a single Indian university is among the top 100, or for that matter, sometimes in some of the rankings, even in the top 200 in the world. And the reality is, while India has historically, and Indian civilization has historically contributed to the development of a knowledge society globally, we could trace the history all the way from Nalanda, Takshashila, Vallabhi, and Vikramshila type institutions. Both the contemporary evolution of Indian education at the dawn of independence, when we had 20 universities, and today when we have over 1,000 universities and 50,000 colleges, the reality is we have not paid enough attention to the need for promoting quality, let alone excellence. Yesterday, we celebrated the National Education Day, marking the 134th birth anniversary of Maulana Abul Kalam Azad, was India's first education minister. And his own vision for promoting excellence and the quality of education still augurs well and is important for us to look at when we think about the future. Our university is part of the vision, and we strongly believe that there are critical elements towards improving the quality of governance in any country through attempts to improve the quality of education, especially higher education in universities. OP Jindal Global University is deeply committed to that idea. There are 5 important aspects of institution building that OP Jindal Global University has promoted since its founding. First, we are a global university. To be a global university means to have a global curriculum, a global course structure, a global faculty, global research agenda, all of which promoting global interaction. We have over 100 full-time faculty members from 42 different countries in the world teaching and researching at Jindal. We have established substantive international collaborations with over 350 universities spread across 65 countries in the world, in which we have implemented 10 different forms of collaborations, which includes faculty exchange, student exchange, joint teaching, joint research, joint conferences, joint publications, dual degree programs, short-term study abroad programs, inward mobility immersion programs, and joint executive education programs. The second aspect of our university is our strong commitment to research. We have established over 50 research centers and 3 research and capacity building institutes within the university. Being an entirely liberal arts, law, management, humanities, and social sciences university with no STEM or medicine disciplines offered, we are conscious of our commitment towards advancing research. In the last, say, 10 years, our faculty members have produced over 4,000 publications, and our citation indexes are among the best universities in the world. They have published over 100 books, and these publications have shaped the research agenda of the university, including having substantial impact in the field of research that our faculty members are advancing. The third aspect of our university is our strong commitment to interdisciplinarity, an aspect the national education policy has given significant importance. We strongly believe that the discipline boundaries that have been created has undermined the ability of Indian higher education institutions to match with its global counterparts. Interdisciplinarity deeply woven in our institutional culture, and that has also enabled our students and faculty members to experience and break those disciplinary boundaries, which has adversely impacted the creation of knowledge and, of course, contribution to research. The fourth aspect of our university is our strong commitment to attracting high-quality faculty members from India and around the world. We pride in the fact that academia is not an opportunity that one ends up having because you didn't get anything better. I must confess that the larger part of Indian higher education, imagination has been to a large extent in the form of institutionalizing mediocrity across academic institutions. The best and the brightest of high school students across India, unfortunately, don't consider academia as an option when they think about the future. They look at all kinds of options and opportunities excepting academia, and this has been one of the major challenges for Indian higher education to match with its global counterparts. We took enormous efforts to attract the best and the brightest young people, particularly from India and around the world, and the 1,000 full-time faculty members that OP Jindal Global University has are an example of the kind of quality and excellence that institutions should foster, with the bedrock of having outstanding faculty members as a part of the effort to create institutions. And the last aspect of any good university is its broader impact with regard to providing access to education. As a private university, we are conscious of the fact that privatization of Indian higher education has unfortunately led to different forms of mediocrity. Private universities have been historically seen to be pejorative, and the idea that private universities need to be contributing to public good is being deeply embedded in our institutional vision since our founding. We spend significant resources to provide access in the form of scholarships and fellowship for those who can't afford to study at Jindal, and that has been part of our mission from our early origins. So in some ways, the outcome of the last 12 years has been truly satisfying. The QS World University Rankings has ranked OP Jindal Global University as India's #1 private university. We are ranked among the top 700 in the world. There are nearly 40,000 universities in the world, and only 22 Indian universities among the 1,000 universities are ranked among the 1,000 in the world, and we are one among them. But more importantly, we are the only non-STEM, non-medicine university that found its place in that list. We're also very delighted to share with you that the QS also published another rankings known as the QS Young University Rankings, those universities which are 50 years or less, and we are ranked among the top 150 in the world. Essentially, they just removed Oxford and Cambridge and Harvard and Yale and Stanford, which are 800 years to 400 years old. Even Delhi University and other such institutions are not ranked, which are 100 years old. They only look at universities with 50 years or less, and we have been ranked among the top 150 in the world. Of course, the crowning glory of all of this is indeed the law school being ranked as India's #1 law school and among the top 76 law schools in the world, and the institution of eminence status given by the government of India. So in some ways, in conclusion, I want to say that the economic reforms that 1991 ushered in the country led to other forms of reforms that I believe is shaping and has shaped the future. I strongly believe that the vision that the National Education Policy 2020 has promoted has enormous implications for the future. We have an extraordinary opportunity to reimagine the future of Indian universities and Indian higher education. The NEP has, for the first time in a long time, created collective political and social and intellectual consciousness among Indians when it comes to what we can and probably should do with our higher education sector. I sincerely hope that public policy impetus in implementing these reforms will ensure that the vision that the NEP has provided is able to be executed. We are very delighted at OP Jindal Global University to be hosting this very special third Global Finance Conclave. It has brought together an amazing group of individuals, starting with this session, the theme of India's growth story from 1991 to 2021 and beyond. Thank you very much for all of you for joining us, and I look forward to the deliberations of this conclave. Thank you.
Thank you very much, Vice Chancellor Kumar. Indeed, an important part of the developments post-1991 is the evolution of our higher education system. So thank you for sharing those thoughts. Before I invite Dr. Subramaniam, I'd like to very quickly introduce him. He has a very long, illustrious career, so let me summarize some of the key aspects. He's an alumnus of the IIT-IIM Chicago Trinity. He's credited among many ideas with introducing the concept of ethical wealth creation in the economic surveys by integrating India's rich economic and spiritual heritage with modern economic ideas. An academic at heart, he has put the nudge theory in practice in India's welfare schemes. His idea of thalinomics, which is what a common person would pay for a vegetarian or a non-vegetarian thali, has been acclaimed as the Indian variant of the Big Mac Index. An award-winning teacher, the youngest chief economic advisor, and astute policy planner who's going to be returning to academia very soon. I'd like to mention that one of his co-authors, colleagues, Dr. Arkaja Chakravarti, is with us in the Banking and Finance School. So I hope we can further work on some of these ideas that you have shared with all of us. With that, let me invite Dr. Subramaniam to deliver his address.
Thank you very much. A very good morning. Dr. Shankar, Acharya, Professor Rajkumar, Professor Ashish, Bharadwaj, esteemed faculty and students. Let me first acknowledge my gratitude for to you all for inviting me to share my thoughts at the Global Finance Conclave. I was particularly heartened to hear about some of the very nice aspects that Professor Kumar spoke about OP Jindal University. Indeed, research and teaching and contribution to public good is something that is very, very important. And you were mentioning about the norm that most youngsters typically do not think about academia. I'm reminded of a particular conversation at one of the, maybe this was about 6 or possibly a decade back when I was there at one of these conferences, and after the dinner, the drinks that followed, so a person came up and asked me, what do I do? I said, I'm a professor. So the person blurted out, maybe it was the impact of a few drinks, saying, oh, I'm so sorry, things did not work out for you in life. So that's oftentimes how we are perceived, and I think role of universities like yours in conveying that it is indeed a noble profession, research and teaching, and the field of thinking about ideas, crafting ideas, as Arkaja would mention. I think it's a genuine privilege to be able to be in that field. Because not only today, but across history, if there is one field where your ideas can live long after your bones have been interred to the earth, it is academia. And I think, and that aspect must be recognized. And I think the role of universities like yours in furthering that is something that I, definitely comment. Thank you very much for contributing to the profession. I'm going to share some thoughts on on reforms. A very esteemed contributor to reforms, Dr. Shankar, Acharya, is here. He has been one of the architects of the 1991 reform, and so I think there can't be a better person to share, on the 1991 reforms. The reforms that we've done, this time are factor market reforms. And today there is an op-ed piece in the Times of India where I actually, postulate the political economy of reforms in a country like ours and why factor market reforms are oftentimes quite difficult from a democratic, perspective, and that's something that has been done, and I think very important. If you, just sort of put an umbrella around the reforms that have been done, it is about, bringing in competition in the factor markets, whether it's labor, whether it's capital, whether it's in terms of power, logistics, the nature of production, so if you take production function as basically just being, labor, capital, and total factor productivity, those are three factors. So each of these reforms are really intended to benefit that, especially focused on manufacturing sector, because jobs in the organized sector are incredibly important if India has to really benefit from the very large consumer base that it has by putting disposable income in the hands of people. And something that I firmly believe, if we take Milton Friedman's permanent income hypothesis, the change in consumption happens only when there's a change, a permanent change in expected consumption or expected change in permanent consumption, and that a job delivers. Those that are temporary do not deliver that change in consumption because the consumer knows that those may possibly get withdrawn. And therefore, in order to generate aggregate demand, in the economy, I think jobs are extremely important, even from the perspective of equity or inequity in society. I think they're all again very important. So the policy push has been really towards equitable growth by encouraging the manufacturing sector, which has the potential to deliver deliver jobs for our youth. But I spoke about this at multiple junctures, so I don't want to get into that. But let me, illustrate something which I think, India now in COVID stands out for its macro policy, both vis-a-vis the rest of the world and vis-a-vis our policy response following the previous crisis, which was the global financial crisis. And I want to, share my thoughts on, how we went about, about this aspect. That's what I'm going to focus on. In some sense, what I want to recommend for a lot of the faculty and the students that are there, a country like ours, there can oftentimes be this tendency to say that everything that an advanced economy does must be good, and let's just copy paste that. And what I strongly recommend to, and something that I genuinely believe myself, is that we have to think from first principles, for the particular situation that we have to handle. Thinking from first principles, I guess, never ever goes out of fashion, and that is something that is incredibly important, because boundary conditions, oftentimes are different, while the trade-offs, economic trade-offs remain very similar across countries, and economic phenomena are similar. The boundary conditions are different, and therefore, we have to think for ourselves from first principles rather than just cut paste whatever advanced economies do. And I think it is time now that Indians have the confidence to say that we can think for ourselves. We've actually been studied at the best universities and can rub shoulders with the best in the world, and therefore there is no need for any difference on this part, and we can be confident to actually say we can think for ourselves. So I will try and use the policy that macroeconomic policy that we've adopted during the COVID crisis as an illustration of this broader theme, a broader thought that I want to share with faculty and students. Let me start out so I'm going to use two benchmarks for comparison. One, as I said, the policy response following the global financial crisis in India, and secondly, if you look at the current COVID response, a couple of issues back, The Economist had a cover story, the cover story was titled "The Shortage Economy." It was called the shortage economy, clearly, talking about the supply side problems that global economy is facing. So, consistent with using first principles, I guess supply and demand never ever go out of fashion, for an economist. And at the macroeconomic level, aggregate supply and aggregate demand, and I think are tools that can help even thinking through the most devastating crisis in a century. If you look at the global economy, fears of inflation that are rising, shortages, especially on commodities, export containers, shipment containers not being available for exports, all these are manifestations of these supply side shortages. And I think, the way I look at it, it is actually, if you look at the Indian policy response following the global financial crisis, as well as the response in other countries, during COVID, it has been basically the Keynesian prescription. There is of course this sort of parodied story that is, mentioned that during a crisis, even if you have to, make people dig holes and fill it back, that's fine. Let them do it. I think that what that characterizes is revenue expenditure, and I'm going to distinguish between revenue expenditure versus capital expenditure by the sovereign, and differ from the Keynesian prescription vis-a-vis the Hicks-Samuelson work on the accelerator multiplier model, which I have been a bigger fan of, especially for a country like India. But let me first share an aspect that I have genuinely believed is really important for a country like India. The decade that I spent in the United States, because I knew very well I would come back to India, oftentimes I was actually, in a comparative mode. Whenever I would look at any phenomena in the US, I would say, what is different in India? Why is it different? And one thing that struck me actually, especially in the food economy, but overall, is these supply side frictions that our economy is infested with. A simple example is, for instance, storage, in the food economy. We don't have adequate storage. The kind of regulations, starting from the Essential Commodities Act and other regulations have actually really not only dulled, but provided a sort of adversely impacted incentives for private sector to come up with, storage and aspects like that. So overall, because of our socialist past, we have not done enough on the supply side. Lots of supply side frictions. And in an economy and in a political economy where campaigns like Garibi Hatao and all actually have gained traction, oftentimes the important point that in order for Garibi Hatao to really happen, you need jobs, and jobs never ever get created without adequate production, without the supply side functioning well. That layered argument has oftentimes been missed. I'll give you an example from, and this was something I credit it to our current chief statistician, Dr. Bimal Roy. He was mentioning that when he was young, the elders in his village used to say, "Oh, these rich people are bad," and stuff. So he used to wonder that the rich person in his town was someone who actually employed a chauffeur, had a few servants to actually take care of his kids, had somebody help to actually for his wife. And if he collected the number of jobs that person was providing, it was easily 10 to 12 jobs that rich person was providing. In contrast, he said that if he looked at the jobs that we were providing, we were using a maid, 5 families, maybe 10 families using one maid. That maid would go into, so 1/10 or 1/5 of a job was what was being provided by those that were not richer. And there has been this this narrative that has prevailed with the none other than the first Prime Minister of this country saying that profit is a dirty word, never ever utter that in front of me. And I think which has led to a policy making that departed from our DNA, and I've written about this in the 2020 economic survey. If you go and read Angus Madison's work, refer to Arthashastra by Kautilya or other writings in India, our own literature. Note, I'm not calling it scriptures, I'm calling it literature, irrespective of what language it is in. If anything in the printed word is literature, if we go and refer to that literature, we would actually clearly come around agreeing that it is trade which is in some sense the actions of the invisible hand of markets, together with the hand of dharma or ethics. Ethics is, I think, a limiting word to actually capture something as profound as dharma. That marriage is what led to prosperity up until 1750-80. India accounted for more than 1/3 of world GDP. So I think it is really important, therefore, to acknowledge the role of supply side, production side of the economy, which we have not done adequately because of the socialist era. And I think that the 1991 reforms that Dr. Shankar Acharya was involved in, and others, I think, heralded a change. But up until now, reforms have basically been mostly by stealth. I think now, for the first time, possibly reforms being done with conviction. But given the importance of supply side, what is it that India did differently during this crisis? Recognizing that the COVID pandemic required social distancing and therefore will require lockdowns, night curfews, etc. One of the first things that was very, very obvious was that not only will there be demand side impact, there will be demand side impact, but the bigger impact will be on disruptions of supply chains. And I think that is something that is incredibly important because, while demand can actually be pushed up very, much faster than supply. Supply usually takes longer. For increasing production, ramping up production, it does not happen overnight. It takes, at least 8 to 10 months or maybe a year for supply to increase, and therefore it requires foresight as well. So what India has done during this crisis, and I think this is, I will hope, will become an important macroeconomic template that countries and policymakers should study, in terms of the policy response, is that India actually focused on the supply side, whether it is through the reforms or through the capital expenditure, because do understand the difference between revenue expenditure and capital expenditure. Revenue expenditure does not create much assets. Capital expenditure, on the other hand, creates assets in the economy and thereby increases supply, supply in the. So the basic conceptual, point let me lay out is that when you do only revenue expenditure, fiscal policy increases demand. And I think, all students actually, we all can work with demand curves and supply curves. If you have aggregate supply not changing, you have only aggregate demand increasing, then I think it is obvious that yes, quantity does rise, but price goes up as well. Translated into macroeconomic terms, this means that there will be a bump to growth. There will be actually, but inflation will go up as well. Now, when inflation goes up, and this is where we have to think not in a static manner, but in a dynamic manner. When inflation goes up, monetary policy has to actually try and unwind that demand. So what you have then is the increase in demand that fiscal policy did, monetary policy tries to unwind it. And so what you have is you come back to square one, so that push to growth that you got is a temporary one, because monetary policy and fiscal policy work at cross purposes. Fiscal policy tries to expand demand through those revenue expenditures. Monetary policy tries to unwind that. And so monetary policy and fiscal policy work at cross purposes. In contrast, if you actually increase aggregate demand and you increase aggregate supply, and I leave this to you to actually draw these curves and see, you will get a even greater push on growth on quantity, but price does not go up, and that is why the importance of aggregate supply. So when you do not have inflation going up in the macroeconomic, then monetary policy can be supportive. So fiscal policy and monetary policy can support each other, work in tandem rather than opposing each other, which is what you actually, if you see what happened after the global financial crisis, what is happening now in the rest of the world, that this is textbook illustration of just the simple concept of aggregate supply, aggregate demand, but thought in a dynamic manner, not in a static manner, that fiscal policy moves first, monetary policy moves next, and will you have fiscal policy and monetary policy working in tandem or in opposition to each other? The other important point to understand is that especially when the economy is slowing down or in a recession, fiscal multipliers are actually much higher, and this is just economists speak for 1 rupee invested by the sovereign, how much does the economy how much is added to the economy, and I think there is very good work in the Indian context by in IPFP scholars showing that revenue expenditure, if you invest 1 rupee, between 92 to 98 paise is what the economy adds, which means there are deadweight costs, and I think students and faculty here will understand that jargon of deadweight costs. Deadweight costs anywhere between 2 rupee to 2 paisa to 8 paisa is what is lost. In contrast, when you do capital expenditure, that 1 rupee that the fisc invests, in the same year, there is increase of about 2.2 rupees, that adds to the economy. But over the period of that capital expenditure, anywhere between 4.5 to 6.5, depending on which study that you actually look at. There's also a study by IGIDR scholars as well. Depending on that, actually, the multiplier is greater. So the multiplier with capital expenditure is much higher. And especially during a recession or in a slowdown, therefore capital expenditure effectively pays for itself over a 3 to 5 year horizon. And this is another very important aspect that we have to keep in mind. So now let me just end with this. Having laid out the conceptual framework, let me illustrate the data. Let me point out the data, why this is actually a textbook illustration of what we actually should expect, and that is what the data tells us. And I'm going to contrast with the GFC in India and the rest of the economy. I already spoke about the global economy, the shortage economy, commodity prices rising, fact that central banks across the world now are basically looking to actually bring down demand, through monetary policy, actually rate hikes, etc. Let me now focus on GFC. Let me give you some data. First up, inflation. During the GFC, without any lockdown, mark that out, without any lockdown, without any night curfew, and the supply side disruptions that is done. Because why? Because when you have fruits, vegetables, etc. Not flying in the night, trucks waiting, and there is going to be wastage, which then affects how much of supply reaches the mandis. So reduction in supply because of these lockdowns and night curfews. So without any night curfew, without any lockdown, we had double-digit inflation for close to 1.5 years, every month double-digit inflation. That's your counterfactual, what could have been if the policy response did not have the clarity and the foresight that actually there was displayed in the current instance. In fact, the inflation would have been greater because, as I said, no supply side disruptions in terms of, like lockdowns, night curfew. So you take that double-digit inflation, add the impact of supply side problems, that is the counterfactual for what could have been if, we did not do, that's point number one. Second point, current account deficit that was close to 6%. Why? Because during the GFC, it was only revenue expenditure, and that revenue expenditure also primarily focused on the more privileged section. So two seminal changes. One was the farm loan waiver. 85,000 crores close to farm loan waiver, and I have actually research published in the Journal of Law and Economics showing that almost all of it was cornered by the rich farmers. So went to the privileged, and pay commission recommendations being implemented. And I think everybody will accept that people like us actually are the privileged in a country like India. So you had revenue expenditure money being put in the hands of people who actually were richer. And as a result, what happened? Supply got changed, so imports had to go up, trade deficit widened, and current account deficit went to an alarming 5.8%. Second fact, second important macro. Third, fiscal deficit. Where peer economies were at 2.5% of GDP fiscal deficit, India was at 6.5% of fiscal deficit because of the profligate spending that was done at that time. Again, following the Keynesian prescription, 2.5 times that of the peer economies. What happened? India became part of the fragile five, and it was actually policy, that was responsible for India actually suffering so much on the macro fundamentals and thereby becoming part of the fragile five. Also, if you look at it in terms of FDI and FPI, I'll give you the about 10 billion outflow of FPI during the GFC, and the FDI about 8 billion came in. In contrast, and now let me contrast with the current period. Inflation, despite the severe disruptions to supply chains, last year inflation was 6.1% on average. After going up a little bit, about 6%, again due to supply side aspects during the second wave, inflation has come down to about 4.5%. So inflation much more benign compared to the GFC, despite these severe supply side frictions. What about the current account? Current account, we have a surplus, 0.9%, very quite comfortable. What about the fiscal deficit? In the COVID crisis, every country has used the fiscal policy, and therefore every country fiscal numbers are actually greater. So if you go by the data provided by IMF Fiscal Monitor, our peer economies are at 10.2%. We had 9.2%. So, less than that of where 2.5 times actually during the GFC versus, 85 to 90% of peer economies. And then, look at the, FDI and FPI. While there was an outflow of $10 billion FPI, which reflected basically investors' lack of confidence and bad policy during the GFC, now there has been almost 36 billion inflow, of FPI. 8 billion inflow of FDI during the GFC, 80 billion FDI inflow during this year. And I think that illustrates actually the numbers speak for themselves, the data speaks for themselves. I think this is just a textbook illustration of basically how macroeconomic policy must be thought about by thinking from first principles rather than just cutting paste what other countries do. In sum, therefore, I would say I think there is too much of the Keynesian prescription. That's what actually happened during the GFC and other countries, including the advanced economies like the US, during the crisis, and less so for other theories. And I think India has actually benefited through this clarity and going by the Higgs-Samuelson framework. And I think both the conceptual thinking and the evidence are actually testimony to this clarity and the foresight. So I'll stop there. Thank you very much to all the organizers for inviting me, allowing me to share my thoughts. I'd be happy to take questions if there are any.
Thank you very much, Dr. Subramaniam, for that impassioned explanation and defense of what we did, why we did, and how we did in the last few months. There are, of course, you would understand that based on what you said, there are a lot of comments and questions coming in. But before we dive into that, I want to move on to the next segment. We have a very special speaker for the next address. It's our privilege to have Dr. Shankar Acharya with us today, a product of the Oxford Harvard tradition. He's one of India's leading policy economists. He has served as a senior economic advisor at the Finance Ministry for a number of years in the run-up to 1991, and he was deeply involved in the reforms of the 1990s as the longest-serving chief economic advisor to three successive governments, Congress, United Front, and the NDA. His latest book, which I believe is his 11th, came out earlier this year. It is titled An Economist at Home and Abroad. I have a copy, and I recommend it to everyone who's listening. With that, let me invite Dr. Acharya for his special address on the pandemic and the Indian economy. Dr. Acharya, you may start while we upload your slides.
Well, thank you very much indeed, Professor Bharadwaj, for that very kind invitation. Since you may have left your copy at home, I have taken the privilege of using this opportunity to be entrepreneurial and showing my recent book, which you said nice things about. I very much would like to thank Vice Chancellor Professor Kumar, yourself, Professor Bharadwaj, and of course Professor Dasgupta for your very kind invitation to be associated with this conference, this very important conference. And I must confess, this is my first significant interaction with Jindal University Global, and it is something I've been looking forward to. And I hope that at the end of my talk, and I'll try and keep it as short as possible, of course, that you will not feel that it had better be the last interaction, but that I shall leave to you to make a judgment on. And with that, and without further ado, I know that you have a very rich program in the next 2-3 days, and I don't want to take time on pleasantries and so on. So let me just dive straight in. I must first start by thanking Professor Amlan Dasgupta for helping me with putting up a sort of slide-based presentation on the subject, not of all that's happened in the last 30 years, but the more limited, my perspective on COVID-19 and the Indian economy. That's what I will focus on in the sort of 25 minutes or so that I have. And so because there's a lot to cover, I will be, if you forgive me, a little staccato in my presentation, aided by these slides, which I have no problem if the organizers would like to make available online later to anybody who's interested. So if I may request the first slide, please. Beyond the, yeah. I think we have to remember that when COVID struck India, which was really in January, February, March, and of course since then of 2020, before that we had a very substantial weakening of the Indian economy going on. I mean, it's another story as to why and wherefore. I don't want to get into that, but just look at the facts. Growth in GDP had declined steadily from 2016-17 at about over 8%, down to 7% next year, and by 2018-19 to 6%. And as you know, in 2019-20, it was down to 4%. And indeed, in the final quarter of that year, it was down year on year to 3%. Most importantly, very importantly, official employment, unemployment data showed us it to be a very poor situation. Dr. Subramanian has talked about the very great importance of jobs. I completely agree. But that was in the worst situation since probably 40 years at least. If you, to sort of just go over the basic facts, the PLFS, that is the Periodic Labor Force Survey for that year, and comparing it to the earlier similar survey of 2011-12, I'm talking now about 2017-18, unemployment had tripled to about 6%. This is just open unemployment. Youth unemployment, which is a certain age group, of course, had tripled also to about 18%. I'm comparing 17-18 to 11-12. 6-year period covers two governments. Most importantly, in my view, female participation in the labor force had absolutely collapsed to something like 23% from 43% 6 years previously. So the employment situation in those 6 years had deteriorated very dramatically. Again, I don't want to get into the causes right now. We don't have the time. Secondly, we know that the investment share in the economy, the investment to GDP ratio, was declining. Thirdly, the export share in the GDP, merchandise export share, had fallen steadily for 8 years, essentially because dollar values had remained more or less stagnant. The fiscal deficit of the center plus states, once you take account of various sort of off-budget items and so on, was as high as 8% of GDP, which is a high number by any international comparison, center plus states. Government debt to GDP was at about 70% and rising. As you know, for quite a few years, the banking sector had been under serious stress. Therefore, the bottom line, I could give you other data, but this, I think, tells us a pretty strong story, which is that even before COVID struck, the economy was in somewhat bad shape from a local peak of around 2016. And therefore, the economy's capacity for coping with the once-in-a-century pandemic was very low. May I request next slide, please? Now, as you know, lockdowns became quite a common policy tool in those early months of 2020, not just in India, but across the globe. However, right around then, in one of my early articles in perhaps April of 2020, in Business Standard, where I write a monthly piece, I was very concerned that while the government was getting a lot of good medical advice, I wasn't sure that they were getting enough of good economic advice from different quarters of the society. And what I was worried about was that, again, in order not to get into the kind of copy-paste syndrome that Dr. Subramanian referred to, that we recognize that India, in many important respects, is in a very different situation than some of the advanced countries from which information comes much more frequently in the COVID context. First, of course, obviously, we are much poorer than these countries, average income of about 1/5 of China's and 1/20 of US, Europe, if you take market exchange rate conversions. Something like, at that time, perhaps 20% of people below the poverty line, and another 22%, and poverty line is very minimalist in our calculations, as you know, the so-called Tendulkar poverty line, and another 20 to 30% only a little bit higher than the poverty line. So nearly half the population close to subsistence living standard. What that means is, in that context, any lockdown which reduces income, because you can't go to work, reduces consumption. It's almost one-to-one. Thirdly, we have to, I think, continually remind ourselves that something like 85% of India's 450 million plus labor force informal or is in the informal and unorganized sector with very low earnings. And we do have some welfare programs, of course, and they have been added to by this government, which is good. But nevertheless, the patchwork system is really very weak if you look at it from a universalistic vantage point, compared to, say, the European-style national welfare systems that they tend to have. And of course, because of our underlying poverty for many years, the health infrastructure system, particularly in the poorer states, is much weaker. So when you do have a lockdown, you get, well, what we saw. You get a migrant crisis, which was totally unexpected to be of that order, or what's called reverse migration, really. You get significant income consumption losses, and this leads to high vulnerability amongst very poor people to all the forms of disease, not just COVID, but also, malnutrition and associated vulnerability that comes to any kind of disease. So when you look at the costs and benefits of lockdown in terms of, COVID deaths saved, that's not enough. You must also look at the potential for non-COVID deaths. Now, this research has not yet been done, so I can't produce numbers, but that was my intuition, and I was very concerned that that initial lockdown from March to June should be as short as possible. Because my perspective, next slide, please. From my vantage point, I thought that we were ignoring the non-COVID related economic costs, not just in economic terms, but possibly on mortality and health terms. Now, as we know, the impact of the March-June 2020 lockdown, which was a national lockdown, was really a huge hammer blow to the Indian economy. Industrial production fell by 50% in April, exports and imports crashed by 60%, government revenues, depending on center and which state you talk about, crashed by 50 to 70%. And based on CMIE data, Center for Monitoring the Indian Economy, something like 110 to 120 million of informal workers mainly lost their jobs, and unemployment soared, I think, at its peak to 23% in a certain month, April, which meant that, if you look at those numbers, 110 to 120 million people, probably nearly every household in the bottom half of the income pyramid of India was somehow affected. And that's important. GDP, as we know, fell by about 24% in April-June quarter on a year-to-year basis. And if you take quarter to quarter, on a quarter-on-quarter basis, it fell 30% in that April-June 2020 quarter. I claim to some, notoriety or fame for being one of the first to predict that this would happen before it had happened. The overall, of course, after mid-May that year, the FY 2021 GDP forecasts were quickly revised by all the banks, investment banks, and I think even the government to something like minus 10% for the full year. Well, the government, I don't think, did that, but credit rating agencies and other institutions did. So this fairly long, national lockdown, and it was regarded by most independent scholars in Oxford and so on as one of the strictest lockdowns when you compare to other lockdowns elsewhere, was, I think, very damaging and left deep scars. Now, it clearly had benefits. I'm not saying that it had no benefits. But I think the question remains live if you want to explain the past and not just about the present and the future. A valid question, which I hope researchers will go into in a proper research way, was that strong and reasonably prolonged national lockdown desirable for so long? But I leave that for future scholars, or current scholars, of which there are probably many in this august audience. Next slide, please. Let's look at it in terms of actual data that we have from official sources as to what was happening to the trajectory of not growth, but the level of quarterly GDP since 2019-20 and up to the most recent times that we have data on. And you can see that the pattern it's right there, that, it had the usual kind of slightly flattish, but growing in the first year, that is 2019-20, which is sort of close to a normal year, except that growth had been slow. And then you have the effect of the COVID and lockdown, and you get a collapse in quarterly GDP by 30% if you take the peak of 3833 and the trough of 2695. And the units are 1,000 crores at 2011-12 prices. So these are real GDP, not nominal GDP. And then, of course, you get the recovery, which is pretty smart, which I think Dr. Subramaniam has often described as a V-shaped recovery, right up to the end of 2021, Q4, where it basically is at or slightly above what it was a year ago. Except, of course, that the recovery is slower than the steep plunge that we saw. But it still looks more like a V than any other letter of the alphabet. However, then we had the second wave, which was basically March to June of this year. And there were associated lockdowns. Now the lockdowns were not national, but done by states and so forth. And you had a substantial drop in GDP as a result of that too, once again. Not as deep as a year previously, but still substantial. And we don't have actual official data after Q1 of this current year, that is 2021-22. But everybody expects, and all the high-frequency data show, that it's going to rebound fairly smartly, as it had done a year ago. And I've just put a number there, as a guesstimate. just to get a pattern. And if you look at the pattern, including the final guest point, I think what you see is a less V than a somewhat straggling W. And of course, the right-hand thing is going to keep on rising, one hopes, so the W will become more apparent. So that's to give you a sense of what has been the shape of GDP as this COVID and associated lockdown has hit the economy. Next slide, please. Now here, and I don't want to spend time on this, but this is in terms of looking briefly at winners and losers from the international dimension. And these are based on IMF data, basically. The most recent, I should add, I haven't sort of had the time to update, but based on whatever was the World Economic Outlook forecast of the IMF and the detailed country-by-country forecast that they give you in April of this year. So it's a few months behind times, and I suspect there are minor changes in all the numbers. And really what I was trying to focus on is how deep was the effect of the lockdown. Well, I shouldn't keep saying lockdown because some countries didn't do much of a lockdown, but how deep was the effect of COVID plus lockdown on, say, a score of countries or regions of the world in 2020, which was, as we know, the trough in terms of impact. And then what was the kind of recovery that one saw or forecasted to see for the subsequent 2 years, which is these are calendar years, 2021 and 2022. And then basically using an index of 2019 equals 100, you again get something of a pattern. And so if you look at the last two columns, especially if you look at the penultimate column, you get an idea of, who were the winners and losers in the first instance. And remember, these are IMF numbers, except for India, where for 2021, I've thought of fiscal 21-22, and since these are IMF forecasts, I have used a forecast of 7.5% growth. I believe it will now be higher than that, more like 8.5% perhaps, but that's marginal, so let's not waste time on that. But what you see is that some of the biggest losers in terms of where they are compared to 100 as the benchmark were UK, to some extent the European Union, but the UK in particular. You see also Mexico, and you see, I think, South Africa, and these were deeply hurt in terms of what COVID and lockdown did to them, and to some extent these damages are continuing, and there are one or two others. And who were the sort of so-called winners? Well, as you know from reading the newspaper, if nothing else, that the big winner in these relative stakes, so to speak, was China, where you can see from that they were by 2021 expected to be somewhere near 111. Might get shaded down a bit because we know that this hasn't been a great year for them, and you can go down, and another sort of reasonable performer was what's called the ASEAN five countries in ASEAN. And the US didn't do too badly either. And this pattern broadly continues in the forecast for 2022. This is just to give you a flavor. We in India are right in the middle of the pack, around about, if we were at 100 in 2019, we are at 100 in 2020, more or less. Might be a bit higher, but let's see. Next slide, please. Okay, now I think we are important not just to look at what's happened so far, but to think about the future. That is, what will happen after we bounce back, which I'm confident we will do, to earlier levels of GDP this year. But what happens in, say, the medium term, the next 5 years? And I try to think through from first principles, and knowing the recent history, what are the main factors to be worried about? And in my view, of course, and these are just a few, and you can probably think of others, that, well, of course, we have a very high uncertainty in both India and abroad about the progress of COVID pandemic. It's still an ongoing pandemic. Though things look like getting better, but still we should not discount further setbacks. The issue of efficacy of vaccines and so on. And of course, the uncertainty about the pattern of global economic recovery. That still remains. Second, I think, is that, as I pointed out in a number of writings, that the COVID has probably left lasting damage to our non-agricultural informal sector and employment therein. And this is a big source of worry because that sector is very, very large in the Indian economy. Third, the biggest component of our aggregate demand, as everybody knows, is private consumption, which is hovered between 55 to 60% of total GDP. And that, I fear, because of the earlier factor, is likely to be on a somewhat reduced path compared to the pre-COVID years. Fourth, I think our performance will be weighed down by record high levels of government debt, 90% of GDP, and the fiscal deficit center and states are very high, uncharted, unrecorded before, of 14% in FY21 and around about 11% in the year that we are in, FY22, though there are signs that it may be a little bit less. And of the associated risks of inflation, which go with these very high levels of deficit, because deficits have to be financed. And as has been done already, much of the financing has been done by the Reserve Bank of India in an indirect sort of way through repurchase of old government bonds. We know that the banking system continues to be severely stressed with high levels, both revealed and potential of non-performing assets and so forth. And so it's a continuing story, but I don't think COVID and lockdown have improved it. And of course, we have long-standing problems of weak infrastructure, the issue of factor markets that Dr. Subramaniam mentioned, very important. Our markets are fairly distorted and opaque for both land and labor. And we have a long legacy problem of weak education and skilling. I'm focusing here more on primary and secondary levels, but in his opening remarks, Vice Chancellor also pointed to the problems of quality in our higher education. The quantity has increased over the last decades. And the last point I am personally very worried about is, in terms of our future performance, is the unfortunate tilt towards protectionism, as I see it, in our country since approximately 2017, making for a less competitive economy and, in the medium term, a weaker export capacity and performance. So taking all this together, and this is merely a kind of guesstimate, I think we will find it difficult on average to record GDP growth above 5% in the 5 years ahead of us. But that's just a thought. Now, next slide, please. I do want to say that, that I've left in the previous slide gives a somewhat pessimistic picture, but I want to now turn to a more optimistic outlook and saying, surely that's not the end of the story, and of course it isn't. Policy can make a difference, and I believe in the last 2 years, a number of significant policy measures have been taken by the government, which could make for a more positive story in the years ahead. However, I should also add that many of these important policy initiatives have some qualifications attached. For example, as we know, there was a major restructuring, and a very important one, restructuring and reform of corporate taxation done in September 2019, just 3-4 months before COVID struck. And perhaps because of COVID, the result has not been the kind of investment boom that one would have hoped for, but rather that company profits swelled without spurring much fresh investment. Second, of course, there were the major reforms of agricultural marketing and distribution. Laws were passed. And here again, as we know, the political reaction has been very adverse and uncooperative, shall we say. And these are, for those reasons, in abeyance at the moment. Third, we have this restructuring of 30 labor laws into 4 codes, which passed Parliament a few months ago. But their implementation still awaits promulgation of the rules, which have to be agreed between the state and central governments, and that hasn't yet occurred. The movement is occurring, I think. And we have to also remember that certain key elements, like the level of the minimum national wage, remain to be specified and could be really quite a serious, potentially adverse effect on particularly employment prospects in the poorer states. Then there's been this year, the recent budget commitment to privatize non-strategic public sector enterprises, which is a very welcome thing. However, progress has not been very strong despite a buoyant capital market, with the big exception, of course, the Air India sale to Tata's, which has gone through, and which is, I think, a hugely creditable achievement of the government, which previous governments completely failed to do. And there is a very recent establishment of a bad bank, the National Asset Reconstruction Company Limited, to solve or at least reduce the pervasive problem of legacy problem of bad loans in the banking system. But this is, again, it's a promising initiative, but it's just got started or getting started. And then there's the launch in April 2020 of the government financed production-linked incentives, or the PLI scheme, to accelerate growth of key manufacturing sectors and their exports. But as I've written in one of my articles in Business Standard, that this could turn out to be a double-edged sword. I don't have them to go into the reasons. Do have a look at the article if you have the time. It's in the November 26th issue 2020 of the Business Standard. Then there is, of course, the recently announced 6 trillion national monetization pipeline for public sector assets. Here, it's a well-intentioned program and a reform, but I think the success of this program depends critically on effective partnerships between public and private sectors, which is an arena, at least if past as any guide, has not seen great success in our country, and it's going to be very challenging. So I put all this to you because I do to be balanced, and I think point out that, there have been promoting policy initiatives of the last 2 years. I think they're in the right direction. I think they're a little late sometimes, but let's see what happens. It all depends on as they say, the devil is in the detail and the implementation. And with luck, perhaps it will bring about a better outcome than the previous slide suggested. Last slide, please.
Dr. Acharya, if you could
yes, this is my last slide. And in case, what I had expressed in the last 2 slides, to summarize it, if the effects of COVID and other constraints on our medium-term growth performance outweigh the reform intentions and actions, then it's possible that we'll have a period of modest growth in the next 5 years. On average, year to year will change. We need to think about what are some of the consequences of such modest growth. Well, one is continuing tragedy of very weak employment situation and poor job prospects. Second, the problem of greater poverty post-COVID and lockdown impact, which we all know about, that this will persist perhaps. Third, this in turn will bring about sharpening of existing social and political stresses across religions, castes, classes, states, and even genders. These are all possibilities, dark ones, but possibilities we should be aware of, which might give us more courage and vigor to pursue reform. Fourth, the increased tensions between central and state governments in the sharing of resources. And finally, of course, if we have slower growth in the next 5 years, it's likely to reduce India's global profile and clout, including weaker strategic and defense capabilities and rising vulnerabilities. So with that, let me bring this to an end, and thank you very much.
Thank you very much, Dr. Acharya, for that comprehensive overview of how we have come to this point, how we performed in the last few months, and where we are headed. We have about 10 minutes left for questions. I have a lot of comments coming in. Let me take the first one to Dr. Subramaniam. It's actually a comment which is about your point in the first few minutes of your address about factor market reforms. And the comment is that most discussions in economic growth literature are really Kuhnian puzzles that only make sense within the neoclassical growth model paradigm. So let me quickly, if you allow me, contextualize that comment and maybe change it into a question for our audience. See, the growth models and the holy grail of total factor productivity in economics have been subject to criticisms both from within the discipline and outside the discipline. One of them is that output, land, labor, capital used are definitionally pure accounting identities and exercises that some say lack multidimensionality that exists in India quite a bit. So now the question is, while the growth models and production functions that you talked about may not really be tautologies as some claim, do you think we know substantially less than we think about growth?
Thank you very much. Let me first, use this opportunity to critique Dr. Acharya's assessment. Let me state right away, I do not agree with it. I think it is maybe the difference between the optimist in me versus possibly the pessimist that economists typically tend to be. But more substantively, and I've written on each one of these, everything that I've spoken, even in my, my remarks and my response now, I will give you, it's all based on very carefully crafted evidence. First, I think it is not okay for us to just say, let's look at the facts and not interpret why, it is what it is. The slowing down of the economy, and I've actually written about this in the 2020 economic survey, volume 2, first chapter. It was because of financial sector problems only, and I think I've clearly delineated that. It is important because when we make assessments about the future, it is important to basically unravel and see what is it that caused it is not structural problems with the economy. Let's be very clear on that. Second, on the employment, and actually here again I've written both in the economic survey and a piece in the business newspapers as well, that when and I think all economists agree that every policy has trade-offs. When you actually implement a measure that has short-term pains and long-term gains, that's better than one that actually has short-term gains and long-term pain. And I'm talking about the formalization of the economy, and I've focused on I've talked about the quality of employment. Yes, what the data on employment that he talked about, is quite right. But when you think from a distributional sense, you have distribution of firms along the productivity dimension. Formalization does impact the least productive, and thereby there is an impact. So I think whenever we talk about employment, it is incredibly important to think about not only the quantity but also the quality. There again, I differ. As for the national lockdown itself, and I think the first chapter of this year's economic survey was devoted to providing rigorous evidence, not only cross-country but across states in India, accounting for all confounding factors that lockdown actually had played a very important role in India actually suffering much less deaths. So I think, we have to be careful to include all kinds of evidence actually when we provide narratives and not just selective pieces of evidence. As for the informal sector, I think this is a very important point. Again, let's think from first principles. I've heard this comment that the informal sector, a lot of international commentary also, that there will be actually, overhang of the problems, which is the concept of macroeconomic hysteresis. But let's understand, how does hysteresis, come about? Hysteresis happens when you have actually, a firm that suffers, decline in earnings. It has to possibly sell some productive assets because it has to take care of its obligations. Because of that, the assets go down, and as a result of reduction in either assets or its productive capacity, there is a long-term impact. I think that's the essence of macroeconomic hysteresis. And here, what is important is to understand the nature of production that happens in the formal sector versus the informal sector. This for the advanced economies and for the formal sector in India, this is absolutely correct, because if they suffer very large declines in, and I will finish this, Dr. Bharadwaj. It is important for me to actually respond because it has very important policy implications. I will really appreciate if you give me the time to respond here. The hysteresis depends on the nature of production. Formal sector firms, because they depend both on labor and capital, and when they have to actually take care of their obligations, have to, let's say, sell assets to take care of those obligations, then there is an impact definitely. Similarly, if skills of labor basically in an economy, if skills atrophy, and which takes much longer than just a quarter or 2 quarters, then again there is impact on there is hysteresis. In other words, hysteresis requires that either capital or labor and thereby productive capacity actually has to be permanently impacted or at least impacted in the medium term. Here, I think this is something that can happen for the formal sector, but has not happened in India precisely because of the cushion that was provided. They actually were, because they were profitable, they did not have to go and sell assets, and therefore the formal sector has actually emerged without any hysteresis. The informal sector depends far more on labor for production, less on capital, and therefore, and if you see as well, take for instance the Q1, the Q4 numbers that came. When the economy recovered, you had clearly, the construction sector activity picking up. So, when people work on the informal sector, it is their labor. So, when the economy, then there are restrictions, they obviously cannot earn. But as soon as those restrictions are removed, they actually come back and earn. I think this again is very important. Oftentimes, they actually scratch the surface and do not think deeply about, enough about the nature of production and the phenomenon of macroeconomic hysteresis. And therefore, it is important. I do not think that the hysteresis in the informal sector will be as high as it could have been in the formal sector because of the nature of production and understanding what hysteresis really is. I think as for the inflation part, and I think this is also important, even if we basically take the, and I've written about the debt to GDP, I think it is important to understand that it's not just higher fiscal deficit that necessarily creates inflation. It is the nature of that fiscal deficit. If the investment that is done creates assets in the economy, increases supply, then it's not obvious that there will be an increase in inflation. I think that again get back to supply and demand. If that fiscal deficit is only spent on revenue expenditure, clearly there will be inflation. But if it is spent on optimally on capital expenditure, infrastructure that creates assets in the economy, aggregate supply increases as well. So again, I disagree that it's not obvious that there will be inflation because the nature of spending has been different. So I think it is important to think deeply about many of these aspects when we actually, and also take into account the plethora of evidence that have been provided in the economic surveys when we talk about actually as for the reforms, and I think some of those caution is definitely warranted, but I would also end by saying that there is a difference between necessary and sufficient. Doing the reform is necessary, dotting the I's and crossing the T's is a necessary condition. But the fact that the necessary has been done, does not take away from the fact that it is not yet sufficient. There are steps that are being taken along that direction. And bottom line, let me mention that 5% in the next year, no way. It will be at least 6% plus. And let's when time passes, let time reveal it. My contention, it will actually be 7% on average, certainly not 5%. And I think, even I will say last year, after the Q1 numbers had come, almost every commentator in India and abroad spelled economic doom. And now many of them are saying, oh, the V-shaped recovery actually is obviously from a base effect. But at the time when I made that prediction about the V-shaped recovery, people did not, and I was the only one who actually said that. So it is not as obvious today as it is being made out to be just because it has manifested. So I think, I will thereby go by my conviction and say that the growth will actually be much higher than what a lot of commentators, actually pessimistic as they are projecting.
Thank you. I have to give Raj some time for his question. Thank you, Dr. Subramaniam, for that.
Thank you very much, Dr. Acharya and Dr. Subramaniam. I'll keep it very short. I am not an economist. I am a lawyer and a law professor. So, Dr. Subramaniam, this question is to you. To what extent you believe that having a strong adherence to the rule of law and protection of various rights, including property rights and contractual rights, is a precondition to achieving economic growth? And I say this because of the fact that the unpredictability of people who end up investing in India when it comes to be it retrospective taxation or for that matter, courts intervening on matters that might have already taken effect, but that was not predicted when companies and corporations invest in India, or something that ordinary people like us even today face, which is that the ability for investing in properties is hugely dependent upon what you pay outside the framework of law. Even today, across the country, the reality is nobody wants to enter into sort of a property-based transaction on the basis of the amount you pay for a property being registered, as opposed to a large amount of money being transferred in the form of cash, and government, of course, suffers due to that as well. So in a way, my question is, how much does rule of law matter to economists like you?
Sorry to interrupt, we have exactly 1 minute, Dr. Subramaniam, if you could give a response in that time. Thank you.
No, I think rule of law absolutely matters. I will refer you, Professor Kumar, to the chapter that we wrote in the Economic Survey 2018-19 on the need for judicial reforms, because that is a very important, critical element of rule of law. I am glad you mentioned retrospective taxation, and we have basically undone the severe damage that was done, through that move in 2012. I think that is clear evidence of us walking the talk, that we want to actually reduce the uncertainty, and we want to do what is on the government side to really enable rule of law. And similarly, actually, there is a lot of focus on ease of doing business. Look at the changes that have happened now on the L1, and that is, many of those recommendations were made in the economic survey. And so clearly, I will mention, and actually say it from personal experience, possibly in the last 18-20 months, I think what is economically optimal, what has been recommended in the economic surveys, possibly in India's independent history, the maximum number of those have been implemented, which actually tells you that this is a government that actually does listen to good economics, and not a government that basically just, despite having, I think, different kinds of people, but actually does not implement good economics. I think the reforms, measures over the last 20 months are testimony to, and a lot of these suggestions having already been made, being implemented, So I think we should draw confidence from that, rather than always looking at the glass half full, or even when it is 10%, always looking at the glass half empty. It's become now, I think last year possibly it made sense. Many people, were not not agreeing made sense. But today, I think with having the recovery, maybe 25% empty, again, just parroting about the 25% empty is not something that I agree with.
Thank you, Dr.
Thank you very much for that comment. Dr. Subramaniam, I'm going to email you the comment and the question, which we will have time for. I have to give, although we are running out of time, I have to give, Dr. Acharya, do you want to quickly respond to that?
Sorry.
Very briefly, please.
To what? To what? What do you want?
To any of the comments that were shared in the last few minutes.
No, I think at my advanced age, my approach is to let time tell who is right.
All right, that's a wonderful note to end this session. Thank you so much, Dr. Subramaniam, Dr. Shankar, Acharya, Professor Rajkumar. We have two fantastic pieces of readings to kind of take a look at. One is, of course, the economic surveys, very comprehensive document with a lot of information and data. And the other one is, of course, Dr. Acharya's book, An Economist at Home and Abroad. Please grab your copy. Thank you very much. This session is now has come to an end. Thanks.